This is Scott Becker with the Becker Private Equity Podcast, the Becker Business Minute Podcast. Today's discussion is about the two types of risk in holding bonds. And this discussion is very important both for individuals and apparently it's very important for banks as well that might not have totally understood the two different types of credit risk involved in bonds and holding bonds. So there's two different types of risk. And very simply, they're what's called duration risk or credit risk. Credit risk is the easy one to understand. When you look at Silvergate Capital, which was the crypto bank that went broke, it suffered from what you think of as credit risk. The people that it lent money to can't pay that money back. At least that's a big part of their risk profile. So that's credit risk. You lend money, and whoever you're lending it to can't pay it back. The second type of risk in holding bonds is duration risk. And duration risk means that you're lending out money or you're buying treasuries, for example, at different durations. Let's say you buy a 1-year treasury at 5%, and 3 years later, treasuries are yielding 3%. You would have been better off buying 5-year treasuries at 4%, so to make sure you keep on getting 4%. Now, the converse is really what happened to some of the big banks, Silicon Valley that went broke and other banks that went broke or are going broke, is they were holding longer duration bonds. So they're holding a 10-year bond yielding 3%, 3.4%. And now all of a sudden, interest rates, the Fed funds rates have gone up to 5%. Now they're at a spot where they're borrowing at 5% from the Fed or from others, and they're earning 3% on their own bonds. This is called duration risk. They're holding long-term bonds that are lower in interest rates than the short-term bonds, and over time, this becomes a bigger and bigger problem. The other thing that happens here is if you're holding a 10-year bond at 3%, and the current yield on bonds is a lot higher than that, then the actual value of that longer-term bond is considered to go down. And it goes down because as an alternative, you could always buy bonds today that are yielding 4 or 5 or whatever percent versus the 3% you're holding. Thus, as you quote unquote mark to market those bonds, which happens every day with bonds, the value of that bond, that 10-year bond, in terms of its value today, goes down because it no longer has as much value because you can get higher yielding bonds on a shorter term. So again, two core types of credit risk or risk in buying bonds. First is what you think of credit or default risk, that your borrower, whoever you're lending money to, defaults. Second is duration risk, that you're holding bonds of a certain sort of yield, and as yields go up, the longer term bonds at lower yields have less value. I hope people follow that well. Again, if you listen to this all the way through and you send me a text, we'll send you a $50 Amazon gift certificate if you're the first person to respond to this. 773-766-5322. Again, text Scott Becker at Becker Business Minute or Becker Private Equity Business Podcast. And again, the title of this is, two types of bond risk, duration risk and credit risk. Thank you for listening to the Becker Private Equity Podcast, the Becker Business Minute Podcast.